Hello, everyone, and welcome to Financial Accounting. Today, we will continue discussing the reporting of accounting changes and errors. Today's video is the second video on this topic, and we will concentrate on the changes in accounting estimates. As we already discussed in the previous video, there are three areas that require unique reporting provisions: changes in accounting principle, changes in estimates, and correction of errors. I'm posting the link to the video about changes in accounting principles here and in the description field. Now, let's talk about changes in accounting estimates. An accounting estimate approximates the amount of a business transaction for which no precise means of measurement exists. In other words, an accounting estimate is an approximate amount that the accountant records into the financial statement when the exact amount is not available. An accounting estimate is made based on the management judgment with the supporting history data and experience. For example, companies estimate useful lives and salvage values of depreciable assets, uncollectible receivables, bad debt expenses, inventory reserves, warranty claims, and so on. Estimates are used in accrual basis accounting to make the financial statements more complete. They are used when events haven't yet occurred but are considered to be probable. Accounting estimate is the result of management judgment based on available information at that time. Sometimes companies need to make changes to the original accounting estimates. This is done due to time, circumstances, or new information. Accounting estimate needs to change when it impacts the carrying amount of existing assets or liabilities on the balance sheet. 2. When it impacts future assets or liabilities. How should a company account for such changes in estimates? If they affect only the current and future periods, a company accounts for such changes in estimates in the period of change. No retrospective adjustments are required. Let's look at an example when a change in estimate affects only the period of change. Assume that Brun Company consistently estimated its bad debt expense at 1% of accounts receivable. In 2022, however, Brun Company determines that 1% is not sufficient as their actual bad debts are higher than what they estimated. In other words, the net realizable value of their accounts receivable is overstated. Net realizable value of accounts receivable is the amount of cash the company estimates will be collected over time from these accounts. I have a video about accounts receivable and the allowance for doubtful accounts. If you need to review it, I'm posting the link here and in the description field. Now let's get back to our example. Brun Company decided to revise the estimate of bad debts for accounts receivable outstanding from 1 to 1.5%. The 1.5% rate is necessary to reduce accounts receivable to net realizable value. Using 1.5% results in a bad debt charge of $150,000. Brun Company records the bad debt expense and related allowance on December 31st, 2022 as follows. For simplicity, we assume a zero balance in the allowance account. The journal entry is to debit or increase bad debt expense for $150,000 and credit or increase the allowance for doubtful accounts for $150,000. Just a reminder, the allowance for doubtful accounts is a contra asset account. It is increased by credit and decreased by debit. The entire change in estimate in 2022 income is included because the change doesn't affect future periods. Companies don't handle changes in estimates retrospectively. Therefore, such changes are not carried back to adjust prior years. Note that changes in accounting estimates are not considered errors. We will learn about the correction of errors in the next video. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.